22 seconds away from the opening bell this morning. Good morning. Equity futures positive by 0.2%. Positive yesterday to start the week. Let's see if we continue the streak. On the Nasdaq 100 up by 0.1% as well. Just a little bit firmer going into CPI tomorrow and earnings as they kick off on Friday. The opening bell in New York City rings. Switch on the board and get to the bond market. Yields look like this. Treasuries pretty stable, unchanged. 398.60 on a US 10-year. Yields coming in a single basis point. On a 10-year, on a 2-year, last couple of sessions, yields lower. Just think about the range on a 2-year. Intraday on Thursday, post-ADP blowout. We forgot about that quickly. That 2-year intraday 511 this morning dropped to as low as 482.20. With that, some dollar weakness over the last few sessions. This morning, some dollar strength. The euro just a touch weaker. Euro dollar a break of 110 in one direction, a break of 110 in the other. 109.91 on the euro against the US dollar. Crude a little bit stronger, firmer, higher, positive by 1%. $73 and about 70 cents, just short of 74. 40 seconds into the session, equities up by 0.2% on the S&P 500. On the Nasdaq, up by 0.1. One sector to watch at the open is big tech. The Nasdaq 100 planning a special rebalancing to curb the dominance of its 7 largest companies. The index saying the adjustment will, quote, address over-concentration in the index by redistributing the weights. Abby has more. Hey, Abby.
Hey, John. And yesterday we had some of these big tech stocks, specifically what's being called the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Tesla, Meta, Alphabet, trading lower with the exception of Meta. Yesterday, Meta did actually get a pop from its Threads popularity and that user surge. But for the most part, these stocks were down 1 to 2%. Today, we're seeing a little bit of mixed action at this point, actually. Microsoft now turning lower, Apple up just slightly, Amazon up slightly, but off of its pre-market lows. So investors are still worried about this rebalancing, and it's a special rebalancing because typically these are an annual or a quarterly event. But it seems that NASDAQ is noticing what investors are talking about, the dominance of these stocks. More than a 50% weighting to the NASDAQ 100. The reason stocks are lower because, of course, index managers, they will have to reduce their positions to the new weightings. We'll know those new weightings on Friday. The actual changes will happen on July 24th. And if that weren't enough, we also have valuation concerns. The Fed, if the Fed suggests in this meeting that they really could be hiking longer and further than expected, that will hit tech. And then, John, of course, earnings for these stocks, it's not until later this month, but lots of pressures here for big tech. And again, mixed action for many of these big tech names.
Abby, looking forward to that. Thank you. Just to stay on tech a little while longer. Guess what Dan Ives is of Wedbush? Dan Ives is bullish. He expects a big tech rally to continue another 12 to 15% this year. We believe a new tech bull market has begun to take shape, being led by the AI revolution. We see better than expected 2Q earnings over the next few weeks. There will be winners, there will be losers, but ultimately we see a strong second half ahead for the tech sector after a pretty blowout first half for tech, particularly on the Nasdaq 100. That's tech later this month, as Abby pointed out. The financials, they begin this Friday. Jefferies upgrading JP Morgan ahead of earnings. The analyst writing, while JP Morgan has been a recent winner, we upgrade the stock to buy given a stable earnings outlook, best-in-class ROE profile, conservative reserving history, and better revenue diversity. Shanali has more. Hey, Shanali.
John, JP Morgan is against the pack. When you look at the expectations for earnings season, there's a lot of pressure on the banks, particularly the regional banks. But JP Morgan, already the most expensive of the biggest banks when it comes to a price-to-book ratio here, is getting an upgrade over here from Jefferies. Jefferies is looking to JP Morgan, Goldman Sachs, and Morgan Stanley to really weather the storm that you're going to see in net interest income as well as any potential worsening credit standards. When you look at what Jefferies is saying about JP Morgan, as well as what Wolfe Research has said, they value JP Morgan for being conservative when it comes to reserving. Remember, there are only 4 banks right now in the KBW Bank Index that are up on the year, JP Morgan being one of them, Citigroup as well, Wells Fargo being another. All 3 report on Friday. Interesting note that Jefferies makes about Morgan Stanley and Goldman Sachs. While they prefer them, Daniel Fannon over at Jefferies is also looking at they call it a tough everything when it comes to sales and trading. They reduced their second quarter EPS estimates for those 2 banks, even while preferring them as a bank, because they are worried about what those numbers look like and when it comes to investment banking sales and
Can
trading.
we just dig into loan loss reserves, Shanali? The FT wrote up a nice story yesterday, actually leaning on some of the data that we have from the analyst expectations around loan loss reserves and loan losses. How bad is this going to be on Friday?
I think you have to watch 2 things at the same time, don't you? You have to watch how much people are reserving for the next couple of quarters consumers in the next year or so, but you also have to see how much those loan loss reserves are converting into credit losses. We are starting to watch some deteriorating conditions, and you're seeing aggregate data show you here that credit, auto, you're very worried about credit cards and auto loans, and a lot of these banks have bulked up on credit card debt to their consumers to boost NII. If you look, when we were talking about that KBW Bank Index, actually the #1 performer is Capital One. They're up 17, a whopping 17% on the year, and they report next week. And so I think you have to watch both the banks and the credit card companies at this time. There's a lot of worries, even when it comes to Goldman Sachs, about their commercial real estate book. So I think it's going to be a very messy quarter here when you look across all of the loan books across all the different banks.
Sonali, thank you. Kicking things off Friday, JP Morgan, Wells Fargo, Citi. I want to get to Uber. Some changes in the C-suite. Nelson Che, the CFO, planning to step down, marking the most significant executive departure since the company's IPO. The company saying this in a statement. Over the past 5 years, Nelson has been essential to putting Uber on secure financial footing and steering the company from billions of dollars in losses. Bloomberg's David Welch joins us now for more. David, the stock's down by about 1%. How significant is this move?
I think Nelson Che brought a lot of stability to the company. He's very respected. Before Uber, he was at CIT. He was at Morgan Stanley. I think on Wall Street, very well liked. If you look at what's happened over the past few years with the company, they went from this huge, crazy push for growth that cost them a lot of money. He reined in costs, even while they were diversifying into freight and goods delivery, so they've got more diverse sources of revenue, pretty good growth still, but they've got positive EBITDA. What they don't have is net income. So I think there'll be some questions here from investors. Who's going to come in next, and what does this mean for the next phase of the company? Because Uber still has a lot of challenges ahead. Even though they still have growth and they've kind of reined in costs and they're closer to net income, they still have never posted actual net income, and they're under a lot of pressure. There are moves in New York City and other major markets to push up the pay for the drivers. There was a recent LRB ruling that says their drivers can unionize, which could raise their costs. And a lot of their positive EBITDAs come from raising their rates for Uber for their fares. How long can they continue to do that? So there's still a lot of challenges ahead for the company, and they're going to need a steady hand at the till to keep costs in check and help the company continue to find growth.
And David, this comes in many cases without any real competition from Lyft, which has been struggling much more, relatively speaking, to Uber. Are you describing just a problem with the industry then? Is this just a difficult industry to make money in?
It is, and it has been for a while. And look, remember, years ago, everybody said you couldn't make money in ride-sharing, ride-hailing without autonomous vehicles. Now that autonomous vehicles are sort of a big question mark themselves as to how well they're going to work and when, people aren't really saying that, but that is kind of working on the distant horizon, isn't it? When you've got General Motors with Cruise and you've got Google's Waymo out there offering ride-hailing with self-driving vehicles in a few different cities right now, that could change the game and really make it tough on Uber and Lyft. In the meantime, it is a big question. How are they going to make money? And even if they get into the black, what kind of margins are we seeing from that business?
Stock down 1.5%. David, appreciate the update. David Welch there out of Detroit on the latest from Uber. I want to turn to some fresh M&A news. Berkshire Hathaway purchasing Dominion's 50% stake in an LNG facility for $3.3 billion. The company writing this: "We're proud of our operations at Cove Point, excited for the opportunity to increase our ownership in these world-class facilities." On a story, here's Katie. Hey, Katie.
Hey, John. Well, Warren Buffett's Berkshire Hathaway now owns 75% of Cove Point after agreeing to pay $3.3 billion to buy out that stake from Dominion. Now, for some context here, Cove Point is a Maryland LNG plant that Berkshire first took a stake in back in 2020. It's one of just 7 operational U.S. facilities that's able to export, LNG right now. And now Berkshire controls it. And for their part, Dominion said in a statement that they're going to use these proceeds to repay debt. And of course, this deal comes after natural gas prices surged in 2020 after, of course, Russia invaded Ukraine. But so far this year, prices have dropped more than 50%. If you look at the reaction in the share price, you can see that Dominion under pressure right now, Berkshire up a little bit. Usually it's the opposite dynamic, John.
Kelly, thank you. So far, their stock is negative. Dominion, at least. The broader market so far up by 0.3% on the S&P 500, 9 minutes into the session. This follows the best first half on record, leaving strategists very divided over where stocks are heading next. RBC's Laurie Cavacina weighing in.
personally feel pretty neutral. I don't feel like the market's been crazy. I do see the potential for some upside, but this is a December 31st game.
JP Morgan's Jack Caffrey planning to navigate the uncertainty by staying up in quality, writing this. One measure of quality we think is compelling is from growing dividends. They're a measure of earnings quality. Encourage management discipline and align the interests of management and shareholders. Jack Caffrey, I'm pleased to say, joins us right now. Jack, I actually wanted to start in the housing sector, where you've really helped lead us through some pretty good moments, actually, for housing. Home builders on the S&P 500 have been absolutely flying. Can we just start with the broader industry? Are we seeing housing trends improve, Jack? Are things actually getting better?
Well, I think when we look at housing, you really have two markets. You have the market for new construction, the home builders, which has been on fire because that's really the only supply. The market for housing turnover has remained really quite sluggish, when you look at mortgage rates that are 150, 200 basis points above what the average consumer is carrying. So you actually have seen the consumer actually forced to stay in their home. And so I do think we're going to continue a bit of a tale of two cities, with the best of times being the builders bringing supply, and the worst of times being still that housing turnover, especially if you were looking to move into something bigger. You just can't find anything, to say nothing about the cost of actually trying to make that move. That makes me think that actually renovation might be the way forward in the existing home stock.
Jack, how much is renovation, the likes of, say, a Home Depot, lagged what's happened with the home builders so far this year?
Well, sure. Looking at the home improvement chains, that they have actually been spending very aggressively, Home Depot and Lowe's, and trying to become more pro/contractor friendly. But that winds up being 30-40% of sales. That leaves 60% coming from you or I having, well, actually, my friend or my son going into Home Depot in order to actually get the wet vac to clean up after the flooded basement. That actually is a nice little pit, a nice little driver. I do think that you have seen some of those costs coming down as you've seen lumber prices falling, bringing in some deflation into the top line, but improving some of the margin story going forward. You are also seeing some pressure on labor, and that's not just a Home Depot home improvement channel, that's a broader retail channel, and that actually, I think, supports the idea that the consumer remains engaged overall. People are working, unemployment's low.
What they're not doing, though, Jack, is taking credit. We saw some of the credit growth numbers yesterday actually pretty low. As you've pointed out, people aren't moving. They don't want to give up 3% mortgages. I don't know many people who want to take on a 7% mortgage. Jack, is that a reason to avoid some of the banks?
Well, I think there are two parts to the bank story. Right now, certainly the mortgage market is not going to be helpful. I do think we're going to be watching credit trends very carefully on Friday. And I think even before we start talking about losses, what are we going to see with delinquencies? You are, I think, especially when you start thinking about credit cards, you're starting to talk about those are loans that are pricing and costing the consumer, for a consumer who's stretching, 20+% on their credit cards to low mid-20s, for a consumer not actually paying down balances. But if the consumer works, generally that's still a constructive backdrop. We've also heard lots of noise about how weak the capital markets are, and so you've seen a lot of fee pressure on the banks, and the more diversified the bank, to some extent, the more pressure they've been under, whether it's lack of M&A, lack of capital markets activity, lack of trading activity. So it does mean, I think, focusing on what's the pressure to raise focus and pressure on net interest margins, as well as what the credit experience looks like. Right now, the credit still looks fairly robust. I think that's reflected in other market measures. Credit spreads remain relatively tight.
Jack, the word defense means different things to different people. What does it mean to you?
Well, I think defense historically would have been looking to places like utilities and consumer staples. And those groups have traded very much like bond proxies this year, with, as we pointed out just moments ago, when Dominion was selling assets to Berkshire Hathaway, stock has actually been fairly weak, and they're using that to repay debt. Consumer staples, you wind up looking at stocks that are trading like that they are almost secular growth stocks, and yet their customer base is not actually expanding all that dramatically. They've been leaning very heavily on price, and retailers are now starting to push back on that price. I think that makes the less traditional sector that becomes more high quality and more defensive healthcare. You're starting to see better utilization. That has pushed and put some pressure on some of the health insurance companies, but points to better volumes, better trends in some of the medical device companies, some of the healthcare facilities companies, which benefit from control pricing, better labor, which actually gets you better utilization, and offers you actually some dividend growth as well. So you can come back to healthcare broadly, a sector that's cheaper than market, has better growth than market, has better income than market, albeit it's hard to find one or two stocks that actually offer you all three of those things in one basket. And I think it comes back to why you can't just buy a single stock and say, that's my view. It comes back to a bit of a diversified portfolio context.
True. Jack, appreciate the input, the insight. Jack Caffrey there of JP Morgan. 14, let's call it 15 minutes into the session. Equities up by 0.1%. Coming up, media and tech moguls gathering in Sun Valley.
I would not put high odds on a transformative deal coming out of Sun Valley. We're in a moment of sort of reassessing and rationalizing.
The summit in Idaho getting underway. That conversation coming up shortly.
I would not put high odds on a transformative deal coming out of Sun Valley. I think we're at a part in the narrative where we went through a flurry of transactions as everyone tried to scale up to lean into streaming. And I think for the most part, the losses have been larger than most people expected. And now we're in a moment of sort of reassessing and rationalizing. It doesn't strike me as a period for transformative M&A.
Tech and media giants gathering in Sun Valley, Idaho, with AI, streaming, potential mergers all in focus. This as Microsoft cuts hundreds of jobs in a new round of layoffs, and Amazon's Prime Day kicks off. Let's get to the coverage. Bloomberg's Ed Ludlow, Punam Gaur joining us now for more. Ed, describe Sun Valley for me. Isn't that the episode in Succession where they go around in those vests and walk around in the valley? Isn't that it?
Exactly so. Summer camp for billionaires. It's interesting what that last guest said, though, because the focus this year is back on TMT. A year ago when I was here, it was only one story, Elon Musk's purchase of Twitter, and he was the surprise guest. But there are two deals we're focusing on. One is the future of Hulu. Comcast owns 1/3 of Hulu, but they have an agreement in place that they can require Disney to buy out that stake. My understanding is that Brian Roberts of Comcast is not here, but the Disney leadership is, including Bob Iger, of course. The other, it's not happening here, but it is Microsoft's $69 billion purchase of Activision. Any day now, a San Francisco judge will decide whether or not to grant the FTC's injunction for a temporary pause on that deal. Bobby Kotick, the CEO of Activision, is a regular attendee of Sun Valley. My understanding is that he will be here, and that could happen in the coming days. So those are two deals we're watching closely. Whether they're transformative or not, in the moment, there is this focus back on TMT. Back on the future of this industry, which was missing in the last couple of years.
Ed, thanks for that. Punam, let's talk about what's happening with Amazon Prime Day. Just how important is Prime Day to this company still?
It's still very important. It's actually about 8% of the quarter's sales, we estimate. So clearly a lot of business will be done today and tomorrow.
How big are the price cuts, Punam? When I look at Amazon now, I don't think of getting a better price. I think of convenience. I was talking about that a little bit earlier this morning. Is it still pretty competitive?
It is, it is. You know, I was looking at some of the deals earlier today, and one that stood out was a Dyson Airwrap that people have kind of gravitated towards for years now. It was 20% off, sold out already. So there are price cuts. Some are as deep as 60%, you know, on Amazon-owned products like the Blink. But if I look at it from yesterday to today, the price cuts on average from just what I'm seeing is probably another 10-20% reduction from what you're typically seeing year to date.
But Ed was talking about streaming. Can we finish there with Amazon? We know that the studios business within Amazon for Prime has released some pretty decent moves, including Air, over the last several months. How significant is that to the overall business?
So Prime Video is very important, but it's also taking up a lot of capital, right? So I think as they invest that capital, advertising is what's going to drive the future. Currently, advertising is about $40 billion in revenues. We think it can continue to outpace growth, even beyond AWS over time, as it is a high profit margin business that will continue to help Amazon's bottom line, which the retail business has, you know, taken up a lot of.
Amazon this morning up by about 1.8%. Punam Gaur there. Ed Ludlow on the latest for tech and for media. We'll stay on top of that through today. Equities right now on the S&P 500, slightly positive by 0.1%. Let's get you some sector price action. Here's Abby.
And Amazon just one of two of the Magnificent Seven that are higher today. We'll be taking a look at that weakness in a moment. But first, if we take a look at the sectors for the S&P 500, a small gain really being helped out by the bulk of sectors. So decent breadth. Materials up top, up about 0.9%. 3M rallying on an upgrade to neutral over at Wells Fargo. But tech and communication services, both of those sectors are down. Let's take a look at something, John, that we've not seen this year. That is the NYSE FANG index. It's now down 4 days in a row. That's the first time we've seen that since December. So this selling for big tech, it's not huge, down 2.1%, but nonetheless, it's consistent. So investors worried about the rebalancing, valuation, the Fed, plus earnings later this month. Again, most of these big tech stocks are lower, including Apple and Microsoft, but Amazon, one bright spot there.
Abby, thank you. Your trading diary up next. Day 2 of gains, second day of gains on the S&P 500. Minor gains though, positive by 0.1%. That's the price action. Let's get to the trading diary. President Biden meeting with President Erdogan of Turkey. That's at 11 a.m. Eastern time, about an hour and 5 minutes from now. Then we get CPI tomorrow morning. The main event for many of you on the economic side, of course, for the market as well. Plenty of Fed speak, Barkin, Kashkari, Bostic, Mester, all ahead of the Fed releasing their beige book. Look out for that. We'll get US PPI on Thursday, plus another round of jobless claims. And then we round out the week with kicking off earnings season, with JP Morgan, Citi, Wells Fargo all reporting, going into next week to round out the rest of the big banks on Wall Street. Looking forward to that coverage. Plenty of action tomorrow, no doubt. Bit of a snooze this morning. That should pick up tomorrow morning when we get CPI data and push ahead to earnings as well. About 26 minutes into the session, equities firmer by 0.1% from New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes
minutes into the U.S. trading day, Tuesday, July 11th. Here are the top market stories that we're following for you at this hour. Less bad for small businesses. The NFIB optimism rises to a November high. Inflation pressures, though, aren't as bad as last year. We're going to get the man behind the data, NFIB chief economist Bill Duckelberg. And wages still a problem. U.S. small businesses have to hike pay. U.K. wages with bonuses near 7%. We see central banks have to come for your paycheck to get inflation at 2%. And the goss from Sun Valley, the media and tech conference kicking off, streaming, golf, CNN, and Disney succession plans, all hot topics. We're going to get the latest from the ground. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. We draw the short straw. We are not in Sun Valley. We are here looking at a market, not doing anything.
Have you seen what Ed Ludlow's wearing? I look forward to our hit with Ed Ludlow a little bit later on. He's got some sort of brown sort of mountain wear on, brown sort of jacket thing going on. I look forward to hearing the reasoning behind it later, but we'll get to that a little bit later on. Yeah, I'm here in a suit, as ever. Question of the day, Alex, all around wages. Wages in the UK are really high. Wages in the financial services sector, 9%. These are incredible numbers, and they're clearly causing consternation among central banks. Alex, last night you had both the Chancellor of the Exchequer here in the UK and the Governor of the Central Bank, the Bank of England, urging wage restraint. The problem is that the issue surrounding wages right now is a supply side problem. There aren't enough workers in the labour market, and I'm not sure that monetary policy really can resolve that issue.
Well, and then to that point, there's been some papers out from the Fed that says the link between wages and inflation is not clear, that wages aren't driving inflation this time around. Jay Powell has said that. So even if wages keep rising, do hikes actually dent that? And is that a problem?
In theory, the Fed has always argued that it wants the wage story to seep out into the wider economy for more and more people to feel the benefits of the strong labour market into wages, benefiting everybody. It seems to have been the narrative. And here in the UK, politicians have talked about the fact they want a high wage economy. Clearly not that high wage an economy, judging by what was said last night. So let's talk about the question of the day. I think this is more of a joint effort. Like Friday's was mine, yesterday was Alex's.
This is ours together.
I think this is a joint effort. Do central banks need to dock your pay to beat inflation? Liz McCormick, Kriti Gupta joining us now. Liz, what do you think? Are wages now the problem?
Well, Jerome Powell would be the first to say, listen, we want people to have a fair wage. You know, we're not trying to kind of kneecap people's, having a good living. But and like Alex was saying, there is some research out there. They're saying maybe not as strong a link from wages to actual inflation. But I think net of all that, they still don't want wage gains going out of control. So we haven't seen that wage price spiral, at least in the U.S. But I think wages are still probably a little high. We have risks of more strikes in the U.S. even. So like you said, there is a lot of wage pressure going on. So I think, like Chairman Powell said, they want people to have a fair wage, but they just can't keep going at the pace they were going. And so I think that's part of the equation to kind of bring inflation down.
I love that you mentioned the strikes across the country, because that was the exact way I was going to answer this question. Essentially, the idea that so many of these companies, from a corporate perspective, have had these massive price hikes, and now they were, although rewarded for it, for the meantime, they are now having to deal with locking in a wage. I think we had the White House acting labor secretary last week saying that the fair wage is what a worker decides it is, and that was in the context of the UPS Teamsters negotiations, largest private union in this country. Well, we have another round coming just tomorrow. The auto workers, the United Auto Workers, basically talking with General Motors, Ford, and Stellantis about renegotiating their contract as well, which is coming due in September. So this idea of locking in these higher wages at a time when inflation is decelerating, it's a pretty scary prospect.
So, Guy, this raises the question. Is it wages, though, that the Fed has to go after if the horse has already left the barn, some animal has left the barn, or is it actually consumption? Like, do we just need to crack down on consumption, forget about wages, they're going to do what they're going to do, but it's the consumption we need to hit, and then how do central banks do that?
But the problem is, though, that wages lead to consumption. Consumption is the last piece in the puzzle.
In theory, but if inflation's high and your real wages could still be negative.
True, and I think there's some element of that, but we're going to get to the point fairly soon when inflation is going to fall below, and you're going to see this in the UK, below wage rises, and at that point, does that take steam out of the negotiations that Kriti's talking about, i.e. you're not going to be able to go to your employer and say, inflation's running at X%, therefore I want X plus 1. inflation is going to be coming down, so you're not going to be able to get the kind of wage rises that you'd be anticipating. The other thing which I think is really interesting here is something that Megan Green's been talking about, and that is that a lot of companies are hoarding labor right now, but when a whole bunch of companies say, actually, we can't hoard labor anymore, and suddenly the labor market frees up, everybody's going to go, we don't need to hoard labor anymore, and suddenly you get this mass unemployment wave that is going to sweep potentially across industry. And suddenly you go from having a really tight labor market to having a really loose labor market. And at that point, the wage negotiation story disappears for labor. Liz, it's a really kind of fine balance at the moment. How much power do you think unions have? How much power do you think labor really has at the moment? And is that power a mirage? Companies are hoarding labor because they're worried at the moment that they're not going to be able to get labor. But if suddenly the labor market freed up, they would, and suddenly this will all evaporate.
Well, you brought up something I was thinking about, Guy. Like, look at the employment data we had in the U.S. The average work week expanded. A lot of people are saying that happened just to the point you said, that companies so scarred from such a labor shortage are kind of holding on to workers. So, but that's not going to last forever. That's why, like, you know, young McCormick, my youngest son, got a job, and I'm like, great, because I think you're right. Eventually, you know, whether this, you know, recession shows up or not, that supply demand in labor is going to get imbalanced, right? So workers are going to have less power, the employer is going to be hoarding less. So I think that's what the Fed and other central banks are trying to get at.
Yeah.
If you crack down demand and slow the economy, eventually things will become more in line with supply and demand of labor.
Okay, yay, young McCormick. We appreciate that. But I'm going to take the other side of this, Kriti, and this is where I think you come in also with the strikes you were talking about. A lot of the industrials, and particularly the transport guys like the railroads, saw that it cost more when they didn't have the labor than they would have saved by firing them during the downturn.
Yeah.
So I just wonder if there is that nut to crack this time.
Yeah, I would argue there is, but I think it goes case by case, because you specifically mentioned the industrials, and that's true when it comes to things like rail strikes, for example, or UPS and their negotiations, very specific with kind of the manual labor. But there is a massive part, I would argue the majority of this economy, that's talking about services specifically. I think the same logic doesn't apply to, say, the tech space, the financial space, even the healthcare space, if you would argue. And
leisure hospitality.
Right, and yet you are still seeing the same push for fair wages, real wages to turn even more positive than they already are, in line with kind of the inflationary story. And I think perhaps that might be where the hiccup is, simply because they are a bigger part of the economy.
But the danger here is that Kriti, is the central banks over tighten because we get to the point where suddenly a whole bunch of companies say we can't sustain this labor that we are hoarding right now. And yet maybe that may be on a sector by sector basis, but suddenly you could have a lot of people being released out into unemployment. And then if I'm another CEO watching that, I'm going, hey, suddenly I've got a much bigger pool of labor, so I don't need to hang on to my guys, because when push comes to shove and maybe I get some extra demand, I can go out there into the labor market and find those people. I don't need to keep them. And at that point, you could see a huge wave of unemployment as everybody kicks out the labor they've been hoarding back into the unemployment pool. And at that point, the central banks may have over-tightened. So the kind of the balance here is going to be really tricky, I think, for central banks.
Yeah, I think it's a completely fair point. But I think where I might disagree with you here is something that Torsten Slok over at Apollo actually put out this morning. He said the mistake or the flaw in the market reasoning is that deceleration, that drop that you just laid out in potential employment or tightening, it's still going to take a year and a half.
Right.
That lag is something that isn't being priced in. And that lag, it's not just applying to the economy, it applies to labor as well. And I think that's why a lot of these unions on a manufacturing level and industrial level feel so safe and secure to be able to negotiate these 3-4 year long contracts, because they know that they're still needed for the time being.
Right, which kind of begs the question, like, how much then does the Fed have to push if we're still waiting for that lag? Guys, thanks a lot. Really appreciate it. Bloomberg's Liz McCormick and Kriti Gupta, a really interesting conversation. Coming up, more on this question of the day. Do central banks need to dock your pay to beat inflation? Amy Will-Silverman of RBC Capital Markets is coming up next. This is Bloomberg.
My view is that the funds rate will need to move up somewhat further from its current level and then hold there for a while as we accumulate more information on how the economy is evolving.
As we get closer and closer to what we think is a sufficiently restrictive level, that's part of positioning ourselves so that we can try and get to that target level in a careful way.
One of the surprising things about the economy is just how much momentum it continues to have. We're likely to need a couple more rate hikes over the course of this year to really bring inflation back into a path that's along a sustainable 2% path.
Those are some Fed officials signaling potential rate hikes as they keep their eye on inflation and the economy. So we want to get to the question of the day. Do central banks really need to dock your pay to beat inflation? Joining us now with her take, Amy Silverman, RBC Capital Markets Managing Director and Equities and Derivatives Strategist. I know you're the market gal, Amy, but what do you think? Are we going to have to get that steep to dock our pay so everything gets calm at 2%?
Yeah, this is a loaded question, isn't it, Alex? Depends if my boss is watching. No, look, I think the way I would frame that in terms of the market is I think the Fed thinks that and the market doesn't necessarily. But, it's sort of a game of chicken, and that's why I think each data point still is so critical because, we can't blink and say, hey, maybe we're okay with inflation at 3% instead of 2%. I think the Fed, has to continue on that path to keep the markets in line for what they want to do to fight inflation.
Amy, talking of the markets, talking of inflation, what's the setup into tomorrow's number?
You would think that it would be really critical, Guy, and I think it is in terms of the information we're going to get. But in terms of volatility, it's, fairly lackadaisical. There's been just the absolute pummeling of volatility, both in terms of implied volatility as well as realized. And what's interesting is if you're, looking at what investors are doing, they're continuing to sell that volatility, even to prints like tomorrow.
So, Amy, to that point, if we just go back, if we do your 2 points together, so you were mentioning that the market doesn't believe that the Fed's going to have to kill the wages to get inflation down to 2%. The Fed does, the market doesn't. Does the market believe the Fed's going to stop at like 3% instead? And does that help explain the attitude into CPI?
Yeah, this is something that I think I'm struggling with and investors are struggling with. And what I will say is, we get periods like this where complacency, to be honest, begets more complacency. When you look at what's priced in, not just for tomorrow, but for 6 months down the line for year end, it's still that same level of complacency. And really, if you think about it, part of it is because those who have tried to hedge, those who have tried to position for this downside in the last 2 to 3 years, Alex, they've just been completely burned. My joke to investors is, hey, what's been the best option strategy year to date? It hasn't been. It's been just being long the S&P. Every single option strategy, unfortunately, has underperformed just being long the S&P.
Wow.
Wow. I wonder whether the second half that may change. Feels like everything's delayed, and at some point maybe it does come to fruition, that hedging strategy. Amy, just looking for catalysts then, earnings Friday. We kick off the earnings season with the banks. Is that going to be a catalyst? Is that going to pick volatility up? What is the strategy? If the strategy into the CPI number is to do nothing, what's the strategy into the earnings season?
Look, for things like that, I always look to history, and historically, the beginning of earnings season tends to actually be a good time to own volatility. Historically, you actually see VIX go higher in August, believe it or not. That's actually a seasonally stronger month for VIX. I think what is happening is and to be honest, this feels a little bit like January of 2018, right before Volmageddon, where you got a lot of this complacency begets complacency. Now, does that mean something's going to happen? It's really hard to say. I'll point to one event outside of earnings, and that's just the special rebalance of the NASDAQ. I think that's really interesting because part of the correlation story year to date has been breadth, right? And you guys have called it bad breadth. And so the NASDAQ has actually gone out its way to say, look, we can't have 51% of the Qs be these 6 names. We're going to reweight it back down to 40%. You saw some individual single stock action on that yesterday. You really saw kind of the Russell names start to outperform. So the question is always related. It's what breaks mega cap tech, because that's something that could break the market. I would point to those kind of catalysts as something that could.
Well, going to the rebalancing for a second, Amy, is the way to play that on a broad index level then, or does it have to be the individual names that are going to be rebalanced?
I think it can be both, because if you think about it, so part of what was related and what caused this was there are just asset managers who can't benchmark to something like NASDAQ when it's not diversified. There's literally a rule from the SEC that says, look, you have to be a certain amount diversified. That's not great when your benchmark is ripping and you can't participate to it, right? So, the opposite also holds true in that, okay, passive funds have to follow in that direction. It can also follow in the other direction. So you may actually see this rotation that we've been waiting for, right? This, like, when does value start to outperform growth? When does small cap start to outperform large cap? I know our equity strategist has been looking for that for a long time. And, maybe it's something like this that gets things moving not only under the surface, single stocks, but finally on the ETF and sector level.
Amy, how different do you think the second half is going to be to the first half?
Yeah, look, I've been joking that the market's version of Murphy's Law is whatever causes the most pain to the most people is what will occur. So, we finally gotten to a point where I would say people are not as bearish as they were at the beginning of this year. People came in so overwhelmingly consensus bearish, and then we've just had this really market outperformance. And so what could really hurt us second half, Guy? It's mega cap tech really sells off.
Yeah,
market volatility rips. We're not positioned for that. And so, it always makes me want to own those tails. It does.
No, fair enough. And Guy, Goldman Sachs had some data out that said the hedge funds are actually slashing their bets on the U.S. and they're moving to Europe. And I wonder if that kind of sets us up for maybe some more violent rotation, particularly if tech gets hit by volatility on the rebalancing, Guy.
The reason to own the U.S. is tech. That's been the trade. And if that unwinds, then the rest of the world looks like it's in a much better position. Take a look at the data out on the UK at the moment, Alex. The UK market looks unbelievably cheap on a PE basis, FTSE 100, 250 in particular. So the rest of the world looks significantly cheaper. The problem is that US tech has done so well, and to Amy's point, you've had to chase it. And if you don't want to be behind your benchmark, you've had to chase it. And that has been the narrative. And if there's any cracks in that narrative, then I think we're in for a different second half of the year. But we all thought it was going to be bearish. It wasn't. Are we just late? Or were we early on that bearishness?
Well, I was funny you brought the UK, because that was going to be my joke question to you for the 11 was like, is the UK so bad you have to own it at this point? It's my narrative.
Alex, yeah. Alex has always been down on the UK. Anyway, Amy, we got to go. Nice to see you. Thank you very much indeed. Amy's boss, I'm sure, is watching. She always does. They always watch her because so smart. Okay, still ahead. The biggest names in tech and media gather in Sun Valley. I can't speak for what some call the summer camp for billionaires. Ed Ludlow has a fantastic outfit on. Look forward to seeing it in just a moment. The startup is next. This is Bloomberg.
All eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Tuesday, July 11th, right here on Bloomberg.
It is 22 past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow from Sun Valley, Idaho, as Sun Valley starts its morning. Now, apparently, you've gotten a lot of shade on your jacket. It looks fine to me, but Guy wanted to know more about it. So let's just start with your clothes.
Yeah, look, this is the billionaire summer camp for billionaires. I'm trying to blend in. In all seriousness, it feels...
Ed, I would have thought a vest, some sort of gilet would have been maybe more appropriate, but you've gone kind of... That feels a little bit more sort of hunting, shooting, fishing to me, though Alex would disagree that suede is necessarily a good outdoor.
Every year for executives from the world of technology, media and telecoms wear a blend of athletic wear and mountain man wear. And it
so
really is summer camp for billionaires.
That's mountain man wear.
I've gone for the mountain man. The key point this year is that actually I think there is a focus back on TMT, because in recent years it's been a bit of a sideshow. I think last year we were talking about Elon Musk's purchase of Twitter. Now actually there are many more stories about this industry more broadly that is facing a lot of headwinds.
Right.
Can I just say the last time I heard TMT was 1999. That doesn't bode particularly well.
Let's bring it back.
Ed is so desperately trying to make this a news hit instead of a fashion hit, so I will help you out with this, Ed. Okay, so TMT is back. What is it? Is it Disney? Is it CNN? What's going to be the topic?
Yeah, all of the above. I mean, there's a lot of doubt that actually any serious deals will get born out of the conference, right? Historically, this is a place where discreetly there are handshakes done on deals in the sector, in the corridors, out fishing, in the mountains, mountain biking. Hulu's a big focus. Comcast retains a third of Hulu, but they are in talks with Disney. They have a right to require Disney to buy out their stake, valuing the company at $27 billion. Brian Roberts of Comcast, I believe, according to sources, is not here this week. But Bob Iger is here. So is Dana Walden, Disney's TV chief, and Josh D'Amaro, who's the parks chief. And so the idea of Disney succession is also there. You know, I remember this time last year, Bob Chapek was Disney CEO. He got out of the minivan with Bob Iger, who had retired from Disney, but things were awkward because it wasn't going well for the company at that time.
Ed, this in theory is where power is centered in this industry for the next few days. But my question is that true? Labor increasingly feels like, and we've been talking about wages today, feels like it has an increasingly upper hand. Have all of these guys and gals got one eye over their shoulder looking at what is happening with the strikes that are taking place?
Look, but behind closed doors, the Allen & Co conference itself, there is always a discussion of the macro. There is always a discussion on the state of the US economy in particular. What is common between the different arms of TMT, tech, media and telecoms, is they've all gone through cuts, workforce reduction. There is an element as well, particularly for the streamers, think about Warner Brothers Discovery, and an emphasis of deleveraging because they need to get their finances in order. Cash burn's been high on the streaming side to fuel content growth. So that is a big part of it. But again, we want to see some green shoots either for the IPO market or for deals. And there are existing deals here where they're happening in the background. Activision, Microsoft, another big example.
Ed, I'm just going to say I like the jacket. I'm not going to diss the jacket in any shape or form. Alex has an issue with it being suede, but judging by the weather, suede looks absolutely perfect. Ed Ludlow, Caroline Hyde, coming up on Bloomberg Technology. Great coverage of this conference. Activision Blizzard's CEO is going to be joining them as well. This is Bloomberg.
Jobs Day, like Bloomberg.
We're about an hour into the U.S. non-trading session. Abigail is tracking the non-moves for us. I mean, I say this jokingly, but it's really hard to gain any kind of traction. Maybe a little movement on the front of the bond market, and maybe in tech.
Yeah, it's tech, and you're right about it, though. S&P 500, NASDAQ, all kind of fluctuating with these non-moves that we had yesterday as well. But we do have moves for tech. In fact, we're seeing something for the first time here for the New York FANG Index that we have not seen since December of last year, and that is 4 down days in a row. Now, it's not a huge slide. It's down 2%, but we have this consistent selling of these mega cap names, what's being dubbed as the Magnificent Seven, all of the big tech names that we all love and know. And yesterday we were talking about the idea that there's going to be this special rebalancing of the NASDAQ 100. So you can see Microsoft, which oddly is actually the top weighting to the NASDAQ 100. It's not just market cap because Apple has the bigger market cap, but there's a secret sauce in there. But you can see Microsoft down the most, down 0.9%. Apple. On the other hand, we have Amazon up, perhaps getting a little bit of a bid here from Prime Day. Wells Fargo also naming it one of their top picks. NVIDIA up 1%, so it's not all bad, but we do have this pressure, and the reason we have it, of course, is because index managers have to sell their positions to match what the re-weightings are. The new weightings are that come out on Friday, and then the actual weightings, the actual index will be trading with the new weightings on July 24th. Some are saying it's not going to be huge, but nonetheless an unknown, plus valuation, the Fed, and earnings later this month. And if we take a look at the 2-year yield, what's interesting here to me is that you have this massive backup. It's hard to believe that it was trading at 10 basis points back at this point, but you have this backup of 4.73%. Who knew that that could actually be the amount of change? But this congestion area actually looks like we could see the 2-year yield go back below 4%. If that were to happen, and I'll be showing it in the 11 o'clock hour, hopefully, the technicals on the New York FANG Index, they are not good at all. So it almost points to me, Guy, that maybe there's some kind of risk off happening. You know, we have CPI, we have earnings, we have the Fed. I don't know, but some of these charts are starting to paint a risk-off picture in terms of folks wanting to go into bonds and out of some of these mega-cap tech stocks.
Yeah. We thought at the beginning of the year that they would go into bonds and would flee from mega-cap tech stocks. Exactly the opposite happened. So maybe a little bit of mean reverting starting to take place. Abigail, great stuff. Thank you very much indeed. We'll continue to watch the numbers very carefully. I suspect the action may come tomorrow. Okay, let's talk about the latest data we can fold into the debate that we're having on the U.S. economy. It comes from the National Federation of Independent Business. And it shows business confidence climbing to a 7-month high. Tight labour markets continue to be a concern. Joining us now to discuss the data is NFIB Chief Economist Bill Dunkelberg. Bill, great to see you. What is your read on these numbers? What should we take away from this data?
Well, that's a nice chart you put up there. 91 is the value of the index now. The 50-year average is 98. So we've been well below average for the last year and a half. And basically, on that chart, if you had the recession markers up there, you'd see this is all recession territory for the Small Business Optimism Index.
Okay, so is it pointing towards improving, or is it pointing towards continued pessimism? Because some of the things were not bad, like passing on price increases, selling prices. Only 29% reported higher selling prices, not necessarily having to pay too much for wages. Like, there are some signs of optimism.
Yeah, there's a little bit in there. The Optimism Index has 10 components. 2 of those components are job openings and plans to hire, and those have been at 50-year high levels for the last year and a half, and they still are very, very high. So we have lots of push on that normally those indices would not be that high, and the index would be far below 90. It'd be more like 1980 when the index was at 80. So those 2 components are really holding the index up. Inflation's not in the index, of course. It's not a forward-looking thing. We've seen good progress on inflation. The percent of owners raising their prices has fallen over the last couple of quarters from over 60% to down near 40%. And that's a good sign, but those historically are still really high numbers. They look like the early 1980s when Volcker was trying to crush inflation in the economy. So they're still too high, but they are headed down, and that's good news.
Bill, are they going to? Is that trend going to persist? I read, I thought, within some of the analysis of the data today, that there was an expectation that actually small businesses think that is going to be a temporary phenomenon, that they will be, that a significant number are looking to re-accelerate and pass more price hikes onto their customers going forward from here.
Well, actually, we ask about plans to raise prices, and that also is trending down significantly, so that's good. Right. The negative is that now we have more firms reporting that they're raising worker compensation than are raising prices. So we're in that sticky range now, where some people would say that maybe we're in a wage price inflation pressure point, but clearly, labor costs are the most important costs for most all of these small firms, and those aren't going to go down. Energy costs can fall, right. But the employees are not saying, "Oh, okay, you can cut my wages now to keep your costs down." That's not happening. Unfortunately, the way we usually do that is to fire people and then rehire somebody at a lower wage, and the people who are fired can get rehired but at a lower wage, and in the aggregate that lowers our labor costs, but it's a painful process.
So Bill, we were talking about this earlier in the hour. Does that process still actually hold, in that if small businesses have found it so hard to find workers and had to pay up for them, that once they have them, they're going to keep them and hoard them and then not fire them if we get into that situation that you were talking about? Are you seeing any signs of that scenario?
Well, they're pretty much hanging on to the employees that they have. You can tell because they've got this huge backlog of unfilled openings, and they keep trying to fill them every month, but they don't succeed. They're not able to hire the people they want. So if you look at the net percent of our firms who report that employment is higher than it was in the prior quarter, you can see that that's trending very close to zero or negative. So they're not making great progress on getting those employees, but they'll keep trying.
Bill, one of the scenarios that is increasingly being talked about by economists is that companies are hanging on to labor because they're worried they won't be able to replace them, and if they have to replace them, it'll be at a higher wage. But at some point, we may get to the stage where a number of companies start laying people off, and that will raise the availability, the available pool of labor, and everybody will be able to stop hoarding labor, because there'll be a big enough pool that they can reach into, as you say, at a lower wage. Do you see any sign in the near future that that might happen?
Yeah, we've had, of course, good news on the layoffs from those big tech firms, but those are not the people that are available usually on Main Street to fill the jobs there. So that really hasn't happened yet. We do see the labor market softening a little bit. There are fewer people are quitting to go find another job. That's the way for the last year you could get a good raise, is to quit and go work for somebody else. So yes, that could happen, and of course you try to hang on to your employee, but if your business, if sales don't support that, then of course you have to let them go anyway and do without. So that's the process that we're kind of heading into, and we'll have to see how deep it goes.
Yeah, there also is a question that the labor market, the overall labor picture, isn't as strong as everybody thinks and as the numbers say. And in part, like Bloomberg Economics looks at your data and small business formation and says that's not pointing to the kind of numbers we keep seeing in the overall labor market data. Do you agree with that?
Yeah, that's correct. If you look at our numbers and other private surveys of firms, we don't see the huge optimistic numbers, that the BLS is reporting. And you see some strange things, like in December of 20, we were down a couple 100,000 workers, had a nice negative number, and then 30 days later in January we suddenly find plus 500,000 workers, and it just doesn't make any sense that it all can move that quickly. So there are a lot of skeptics now that think that the job market strength is being overstated.
Yeah, Bill, really great. Love the survey. Love talking to you, Bill Dunkelberg, National Federation of Independent Business Chief Economist. Thank you so very much. And Guy, that's quite interesting because that was sort of the narrative going into Friday, right? That the numbers can't hold up as well, that there are still cracks forming, that we need to revise it down. But again, the question is when? When do we see that big revision down?
It's all happening much more slowly than we anticipate.
Yeah.
That has been the story of the first half. The question then becomes, does it accelerate in the second half? And this is why I keep going back to this idea that suddenly you could get this wave of layoffs. And it becomes a wave because as one company do it, it encourages the next company to do it and encourages the next company to do it. And at that point, unemployment accelerates very sharply. And it's interesting, you look at historical data, unemployment doesn't rise gradually generally. It generally rises kind of really quickly. Once it gets going, it rises really fast. And this is what Elizabeth Warren was talking about, has been talking about, this idea that suddenly the Fed will lose control of the narrative on the unemployment front.
But on the flip side, in order to do that, you really need to see demand come down, not for labor, but for stuff. So if the demand stays high, it's going to be hard to crack it. It's more like we have to crack the consumer before we crack the wage picture. We have to just stop buying stuff, like I've been doing. Just saying.
To a point.
To a point.
To a point.
To a point. All right, coming up, sports. We're going to head to Capitol Hill as PGA heads to testify before a Senate subcommittee on the proposed PGA Live Golf merger. Ron Price, the PGA COO, being questioned right now by the subcommittee's chair, Senator Richard Blumenthal. This is Bloomberg.
We've talked about it at board meetings, a structure similar to what we've set up. We decided to not pursue it at any point in time because we'd still be in litigation and still be fighting the public investment.
You are looking at a live shot at the Senate subcommittee hearing on the planned merger between the PGA Tour and Live Golf. The PGA's COO, Ron Price, was just questioned about Saudi Arabia's investment. The question is how big the investment can be, what kind of power they can wield. Joining us now to break it all down is Bloomberg's Kaylee Lyons and Scarlett Fu. Kaylee, you're there, you're on the ground. What's going on? Who's there? What's the point of this hearing?
Well, the people that are here are not originally the people that the chairman of this committee, Richard Blumenthal, wanted to be here. Yes, there are 2 representatives from the PGA, but Jay Monahan, the commissioner, is not one of them, as he is out on medical leave. And the CEO of Live Golf, the chief of Live Golf, also isn't here, nor is anyone from the Saudi Investment Fund. So I asked the chair of the committee, Senator Blumenthal, especially after the ranking member of this subcommittee, Ron Johnson, said he didn't think they should be having this hearing, what the point was, what exactly he was trying to achieve. This is what he told me before he went into the room.
Our hope is to uncover the facts, because these facts are important to America's national interest. Golf has a central role in our society. Sports have a central role in our culture and our national interests. They are economically impactful. They determine our self-image and our image abroad. And so the American people deserve to know the facts surrounding this deal involving sports washing by the Saudi government.
So he says the point of this hearing is to get to the facts. The question then is, what exactly can Congress do with the facts? This subcommittee does not have the power to block this deal going through. But what the senator did tell us reporters was that they can produce reports, recommendations, even legislation, and the facts they do uncover can be used by the Justice Department as they look into any potential antitrust concerns. And of course, the DOJ, based on that competition issue, could be the power that could block this deal from going through.
Scarlett, Kelly's talking about facts. There are no facts at this point. This deal is what, 6 pages long at this point? It's less than 10.
5 pages.
5 pages. The deal has not been done. It falls apart in December if they can't get onto the same page. Why are we doing this at this point, particularly given the fact that Liv's not there, the Saudis aren't there, the head of the PGA's not there? This looks like, I wonder what's really going to be achieved here.
Right. Well, this is highly emotional, right? There is a lot of discussion about 9/11, and of course, one of the people who is supposed to be at the hearing today is Jimmy Dunn. He's a Sandler O'Neill co-founder who brokered the deal between PGA and Live Golf. He was actually working in the World Trade Center on 9/11, except that day he went golfing, so he was not in the actual building when it happened. And so he's played a big role in terms of helping rebuild his firm and supporting 9/11 families. A lot of 9/11 families see his role in this brokering this deal as betrayal. So there's a lot to get worked up around when it comes to the emotion, and of course there's a lot of questions as well about the role of Saudi money in sports overall. We know the Public Investment Fund, the Saudi Arabian Sovereign Wealth Fund, has about $2.3 billion in soccer deals, including 80% of Newcastle. So there are questions about whether they're going to enter other sports leagues and also try to buy up stakes as well.
So that's Jimmy Dunn right there talking. Scarlett,